Welcome back to Project Polos. In the previous lessons, we completed the full senior debt section, including repayment mechanics and the lender protection features we modeled. In this lesson, we are going to integrate the final missing piece of the model, the equity section. The goal is simple. We will calculate equity contributions and dividends so that we can finally determine the key equity outputs on the dashboard: equity IRR, MPV, cash-on-cash yield, and payback period. If you're new to this Deal Lab series, I recommend starting with part 1, where you can download the model start file for free and build the model alongside me. Link is in the video description below. And now let's move back to the model checkpoint file from our previous lesson. In the previous lessons, we have completed our senior debt sections, which means we can now finally model our equity. And in this lesson, we will focus on finalizing our free cash flow to equity. And once we determined our net free cash flow to equity after equity contributions, we are ready to model our return KPIs. But before we get going, first thing we will do is switch over to case 1, so it's not a cash sweep case. Hit the master macro. And then you might remember from previous lessons that our balance sheet in our integrated financial statements sheet is still not balancing. And the reason for that is that in the equity section, our share capital account is still missing. So before we start modeling, we will go to our checks sheet and actually activate our balance sheet check again, so that we see whether we actually get to balance our balance sheet once we have fully implemented the equity section. So we will get started with the share capital account up here. Essentially, the issue that we have right now is that our debt alone cannot fund 100% of the project. So if the model shows assets that are being built and then sit in the PP&E account, but equity hasn't been posted into the balance sheet, we will always have a mismatch. And what is the share capital account? You can think of share capital as the permanent equity funding injected by the sponsors into the project company. It's basically the paid in equity at financial close or during construction that makes the capital structure work. And to implement the share capital account, let's set up our typical account logic. So the balance brought forward is the previous period's balance carried forward. This is going to be the sum of our balance brought forward and drawdowns. And our drawdowns are going to be our equity contributions. And in this case study, we have an acquisition financing at financial close, which is the 31st of December 2025. So also equity is fully contributed on that financial close date. And to model our drawdowns, we will actually model our equity contributions in row 689 first. And our equity contributions are going to be equal to all of our CapEx spend. So let's scroll up to our CapEx section. CapEx is right here, around row 300. And if we scroll down, we have 2 total CapEx sections. One section just focusing on hard CapEx, and then one section also including our financing fees. And since the financing fees also need to get paid, make sure that you pick up row 355. So we take the total in row 355, which is 173.8 million for case 1. And then we will subtract all of our senior debt term loan that we have raised. Scroll down. So the equity sponsor essentially does not have to put in the full 178 million, but we will subtract our drawdowns under our term loan. So we draw down 137.4 million, which reduces our equity contribution necessary. So subtract row 554, hit enter, and let's move that to the right, Control R. And those are essentially our equity contributions, meaning the equity cash outflows at the beginning of the project. So for our share capital account, all we have to do is link our drawdowns from our equity contribution row down here, pick up this number, and let's drag this one over, Control R. And check this out, our balance sheet seems to balance now. Let's move over to our balance sheet. And you can see that net assets now do indeed equal our total equity in each row. That's also a great sign that apparently we did not do any mistakes in the previous lessons, at least not mistakes leading to a balance sheet that is not balanced. So that's a great sign. Let's move back to the operations sheet. And now a question that a lot of students will have is, why does our balance in our share capital account stay consistent over time? And that is because in most project finance models, we assume equity is not repaid as principal like in our debt section. Instead, equity returns are made through dividends, which we'll model down here. So dividend distributions do not reduce share capital injected. So essentially, share capital just increases when we inject equity, and then it usually stays flat afterward. And the actual returns to equity investors will show up as dividend distributions and not as share capital repayments. And to model our equity dividend, we will have to pull in a bunch of different items right here. But before we can pay any dividend, we first have to even determine if we are currently in lockup under our financing section. So first thing we'll do is pull in our lockup flag from our financing section. So that is equal to our lockup flag. Scroll up. And our lockup is right underneath our DSCR section, where we determine if we might be in a lockup in any given period. So select 589, drag it over, Control R. And that will be turned on in, say, case 21, which includes a cash sweep. And then the first thing we will look at to determine our dividend available for distributions is our actual cash account. So very first thing is, let's take a look at our cash account. So pick up from our integrated financial statements at the end of our cash flow statement, our cash brought forward. So that is the cash that is sitting in our account at the beginning of the period. And right now you see we build up a lot of cash because we have not yet modeled any equity distributions. So let's pick up this cash item. And once we have our cash, we can pull in our CFETs. So the CFETs are after all the adjustments of revenue, after OPEX, for instance, to determine how much cash is available to our lenders. And CFETs sit right at the top of our senior debt section. So pick up row 487. And obviously we cannot fully distribute total CFET, so we'll have to make a bunch of adjustments for our debt section. And before we do this, let's actually drag those two over to the right, Control R. And then let's also model our dividend available for distribution, which is going to be the sum of all of these items. And we will multiply this with, open parentheses, 1 minus our lockup flag. So if our lockup flag shows up as 1, then this will turn to 0 and we will not have any distribution. Close parentheses, hit enter, drag this one over, Control R. Actually, let's undo this, Control Z, copy this, paste it special as formula, Alt H VSF, hit enter. And right now we will be distributing $3.8 billion because we would always distribute the full cash amount, because we have not yet linked in our equity dividends down here, which will ultimately flow into our integrated financial statements and then actually reduce our cash in our cash account. So let's do this right now so you can see the effect. So this just simply equals row item 685, so our dividend available for distribution. Drag this one over, Control R. And right now we would obviously be over distributing our cash because the dividend distribution right now equals CFETs, but we need our CFETs to repay our term loan and pay our term loan interest. So that's why we get a negative cash line. What we have to do then is pull in all relevant term loan adjustments and debt adjustments. And let's start with our term loan interest. So these numbers here are positive, or CFETs are positive. So let's make sure that for our term loan interest, we pull in a negative number, reducing our dividend available. And the interest that we want to pick up is the interest including our base rate sensitivity in case we are sensitizing our base rate. So pick up minus 573. Then for our DSR LC interest, we can just pick up the macro paste row, also negative from right up here. That was the end of the last lesson where we modeled this. So minus K664. And the term loan principal sits in our term loan account. So let's scroll up. And our term loan account in row 555. We have our principal repayment, which is already negative, so no need to flip the sign. Pick up 555, and let's drag all of this over and see what happens to the overall cash balance. And look at this, because we're not in a stress case, our cash account does not turn negative anymore because we do not have any adjustments for a cash sweep, DSR, LC drawdown, or repayment. But let's also make sure that we are prepared for any stress cases. So let's pull in our cash sweep. That equals to our cash sweep section. And that is our paste row for our cash sweep in row 604. And this paste row will probably show up positive. So let's pick up minus 604 and then check with our actual cash sweep case whether that's the case. Drag this over, Control R, and let's flip on a cash sweep case, case 21. Hit the master macro. And you can see that our cash sweep now shows up right here in years 2031 to 2034. Let's scroll up. And the cash sweep row here is indeed positive, so we flip the sign to make sure that it's flowing out negative in 682. Then let's move on to our DSR LC drawdown and repayment, which are our last two adjustments. So we can just scroll up to the section we modeled in the previous lesson. And that comes from our DSR LC balance, where we have a drawdown due to cash shortfall and a repayment in 647. So I think we shouldn't be required to flip any signs. So let's pick up 646 for the drawdown and then copy this, paste special formulas for our repayment as well. Let's drag all of this over and then we will test it. So what we've done in a previous lesson is switch over to case 2, hit the master macro, and then we have stress tested the availability assumption to 78%, which makes our DSCR be barely below 1. And let's just hit our master macro so that we actually also copy and paste the DSR-LC interest on the drawn amount. And you will see that the DSR-LC drawdown is a positive movement, increasing our cash, which is expected because it's essentially cash shortfall that we have in the SPV. So this makes up for any cash shortfall. And once we have enough cash available to repay our DSR-LC, that flows in negative, not leaving us any dividends except in year 2040. So all of these adjustments seem to work and are reflected properly, which means we can now model our net free cash flow to equity, which will then be the base for our levered equity IRR and NPV calculations. So our net free cash flow to equity is going to be our dividend, which is a cash inflow, and then we will subtract our equity contributions, which are a cash outflow at the beginning of the project. Drag this one over, Control R, And you will see that for the $36 million the equity sponsor puts in at the beginning, in this stress case, we would get out a net 46 million over a period of 20 years. This is obviously a stress case, so let's actually delete this availability reduction right here. Go back to the operations sheet, hit the master macro, and you will see that in the base case, live case 2, which is an equity base case, we actually expect to put in 36 million, get out dividends of 163.4 million, which leads to a net free cash flow to equity of 127 million over a period of 20 years. So with the net free cash flow to equity as basis, we can move on in the next lesson to calculating our return KPIs, which is our levered equity IRR, the net present value assuming a target minimum IRR, our cash on cash yield, and our payback period. And finally, let's move to our integrated financial statements, where you will also be able to see our free cash flow to equity in row 87, which is then fully distributed as dividends in row 90. And now look at our cash account. Our cash never turns positive because now we fully distribute it as dividends. The only cash that we ever build up is in our restricted cash account for the major maintenance reserve account, where we save up for our scheduled augmentation events. The dividend distribution is also showing up in our income statement, which then affects our retained earnings account. And our retained earnings account is also showing up on our balance sheet, which essentially ensures that our total equity is always balancing even after we distribute our dividends. Alright guys, this was it for this lesson, and I will see you in the next lesson when we will tackle our final return KPIs. See you there.